By definition, regulation lags innovation, right? If the bureaucrats who create regulation could instead be founders coming up with entirely new models for industries and businesses, everything else, they would do that, right? So it's not surprising that a lot of new technologies, new products, new services aren't already addressed specifically in law how to cover them. And that was the case with Uber, which was Travis didn't invent the idea of paying someone to take you from point A to point B. Taxis existed, livery services existed, but he did come up with just a much better way to do it. And then the question is, okay, if it's app based, if it is based on mileage as opposed to distance or time, or if all these other features are now part of the process, features that, by the way, consumers loved. Is it still legal? And so, as we would enter every market, the taxi industry, which the truth is brought this on themselves, because for decades and decades and decades, they took advantage of their customers. They took advantage of their drivers. They didn't make the cars better. They didn't make them nicer. They didn't make them safer. They did nothing to improve the product or the service. And then finally, when Uber came around, people were ready for something different, for something better. And so we would enter a city. The city would typically issue a cease and desist order saying, you can't operate. Our view was, you don't have the right to tell us that we can't operate. So we typically ignored it. And what we did was we built up our customer base in the city, in part to build a business, but even more importantly, we believed, and the entire campaign and business in many ways was predicated on this one core belief that Travis had, was our customers will fight for us to keep us, because they so prefer our service to what they're used to that we can count on them. So if we can generate enough people in any given market, then we can fight effectively. And so what happened was, basically in every case, they would try to shut us down. There'd be some sort of law or proposed or something that would say Uber is not allowed. And then we would go to our customers and say, listen, if you like this service, if you want it to continue, we need your help. Press this button and it will get a message to your local city council member, the mayor, whoever the relevant elected official is, telling them, leave this thing alone. And guess what? Millions of people did it. And we so overwhelmed the other side that every politician makes every decision solely based on the next election and nothing else. And they just don't want to piss off any more voters than they have to. And so when they realize, like, oh, my constituents really don't want me to cancel this thing, then all of a sudden that became more important to them than doing what the taxi industry wanted. And we won in every single market in the US.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast, and today we have Bradley Tusk with us. Bradley is a venture capitalist, political strategist, philanthropist, and writer. He is the CEO and co-founder of Tusk Venture Partners, the world's first venture capital fund that invests solely in early-stage startups in highly regulated industries. In this episode, we talk about how Bradley helped Uber get legalized across the United States of America, their investment thesis of investing in highly regulated industries, how they manage risk within the portfolio, how should early-stage startup ascertain and manage regulatory risk with their business, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs, that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing, to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Bradley. So good to have you on the VC10X podcast. How are you doing?
I'm great, Prashant. Thanks so much for having me on. I'm really appreciative.
Yeah, it's a pleasure having you on. And to start things off, can we first start with what inspired you to start Tusk Venture Partners?
Yeah, so my career is a little different than most people that you have on this podcast. I started off in government and politics. So, for example, I was Mike Bloomberg's campaign manager when he ran for mayor of New York City. I worked for him at City Hall. I was the deputy governor of the state of Illinois for 4 years. I ran the state's budget operations, legislation, policy, and communications. I spent a couple of years on Capitol Hill as the communications director for Chuck Schumer. Chuck is the majority leader in the U.S. Senate. And then I had to pivot into tech kind of by accident. I ran all the campaigns for a little known startup called Uber to be able to legalize ride sharing, and it worked. We won. It became a very, very well-known campaign. I happened to have taken most of my fee in equity, and that really paid off financially, and enjoyed it quite a bit. Did it again with Clear to get them into airports. That worked too. And then I started to sort of hit me like, you know what? There's a bigger nexus between tech and regulation than I think most people, either on the political side or the tech side, might realize. And my partner, Jordan Knopf, was at the time running Blackstone's internal venture fund. Jordan and I met through a founder we both knew. And the question we started asking ourselves is, if you really understand regulatory risk, if you can truly underwrite it, and then you could do something about it, how much of a better investor would that make you? And we didn't know what the answer was, but we felt like it was worth trying out the idea. We went out and raised our first fund. It was incredibly hard to raise a first fund, like it is for probably everybody, but even a little harder for us maybe because I'm such a non-traditional VC that I think that makes investors even a little more nervous. We raised our first fund in 2016, and in many ways, we're like every early stage fund. We're looking at the TAM, the founder, the underlying tech, the underlying idea, all the usual stuff. But then we ask two questions that are somewhat unique to us. First, is there a gating regulatory issue or opportunity that if it were solved could really drive growth and valuation? And second, if so, can we solve it? And when the answer is yes to both, that's when it really makes sense for us to deploy capital.
Absolutely. That's super interesting to learn, and we'll get deeper into Tusk Venture Partners. But before we do that, you mentioned that you were directly involved with Uber and helping them be legalized in a way because there were regulatory hurdles initially, and that's a story that's talked about a lot, especially in this space when you talk about is this legal, is the startup legal or not, and people say okay, Uber wasn't legal to start with, so
it was great.
Tell me more about that story, somewhat in detail, and how what's the process of getting it legalized and what was involved?
Yeah. So look, I mean, Uber, this happens a lot. So by definition, regulation lags innovation, right? If the bureaucrats who create regulation could instead be founders coming up with entirely new models for industries and businesses, everything else, they would do that, right? So it's not surprising that a lot of new technologies, new products, new services aren't already addressed specifically in law of how to cover them. And that was the case with Uber, which was Travis didn't invent the idea of paying someone to take you from point A to point B. Taxis existed, livery services existed, but he did come up with just a much better way to do it. And then the question is, okay, if it's app-based, if it is based on mileage as opposed to distance or time, or if all these other features are now part of the process, features that, by the way, consumers loved, is it still legal? And so as we would enter every market, the taxi industry, which the truth is brought this on themselves, because for decades and decades and decades, they took advantage of their customers. They took advantage of their drivers. They didn't make the cars better. They didn't make them nicer. They didn't make them safer. They did nothing to improve the product or the service. And then finally, when Uber came around, people were ready for something different, for something better. And so we would enter a city. The city would typically issue a cease and desist order saying you can't operate. Our view was you don't have the right to tell us that we can't operate. So we typically ignored it. And what we did was we built up our customer base in the city, in part to build a business, but even more importantly, we believed, and the entire campaign and business in many ways was predicated on this one core belief that Travis had, was our customers will fight for us to keep us because they so prefer our service to what they're used to that we can count on them. So if we can generate enough people in any given market, then we can fight effectively. And so what happened was basically in every case, they would try to shut us down. There'd be some sort of law or proposed or something that would say Uber is not allowed. And then we would go to our customers and say, listen, if you like this service, if you want it to continue, we need your help. Press this button and it will get a message to your local city council member, the mayor, whoever the relevant elected official is, telling them, leave this thing alone. And guess what? Millions of people did it. And we so overwhelmed the other side that every politician makes every decision solely based on the next election and nothing else. And they just don't want to piss off any more voters than they have to. And so when they realize, like, oh, my constituents really don't want me to cancel this thing, then all of a sudden that became more important to them than doing what the taxi industry wanted. And we won in every single market in the US.
That's a crazy story right there. And so what was the specific part of Uber that was considered not legal?
So, I mean, it was all made up, to be clear, right? Because it wasn't like before we started doing it, there were any views around it. But different cities would use different things. So, for example, I remember Boston said, well, you have to use a certain system of weights and measures to calculate pricing and mileage, and you're not using that. DC said, oh, you can't use an iPhone. Other people said, oh, taxis have to be hailed on the street. You can't prearrange a pickup. So they would just figure out specific components of our method and of our model, and then just say, oh, this particular thing isn't allowed in Phoenix, in Denver, in Salt Lake City, in Philadelphia, whatever it is. And every single time we had to just go in there and mobilize our customers and win. The kind of most famous fight we had was here in New York City, where I'm based, where the mayor, guy named Bill de Blasio, was his second biggest campaign donor were the taxi industry, and they desperately wanted to stop Uber. And he introduced a bill that would have eliminated all new licenses. And, when you go on Uber, you have your choice of what kind of Uber you want. You could have Uber Black, Uber X, Uber Comfort, Uber Pet, whatever it is. We created a mode called de Blasio, the name of the mayor. And when you clicked on it, it said 25-minute wait time, press here to stop that from happening. And in the course of a week, we went from being dead in the water to overturning the city council bill and then completely walking away from their own plan and their own bill.
Brilliant story. And so when this was happening, when you're faced with so many regulations from different regions, you're faced with two options. One is to comply, and the other is to do what Uber did. That is to use the force of power, the force of your customers to try to make them accept what you are doing and let it be legal, right?
Yes.
So why did Uber choose the second option and not the first option?
So for Uber, it was existential, right? It's funny. I wrote a book a couple of years ago called The Fixer, and I have a whole section on when to ask for permission and when to beg for forgiveness, which is effectively the question you just asked me. And it's not, to be clear, I think people often assume that I'm just going to say just do what you want every time. That's not true. It depends on the circumstances and the context. So in our case for Uber, one, if we had waited for permission, we never would have gotten it. We never would have entered any market. We never would have existed. Two, the penalties that we faced were not that severe, right? So they would impound the car. They would give a ticket. There are things like, for example, one of my first investments out of our fund was a company called Lemonade, which is a property and casualty insurer. In Lemonade's case, we didn't start selling insurance online without getting licenses from each individual state because that would have been jail time, right? And that's a very different. So part of it is, one, what kind of penalties are you facing, right? If like when I did Bird, you're going to pound the scooter, okay, no big deal, take the scooter, right? Even the car, take the car, right? If it's the CEO and this management team and the investors are all looking at 5 to 7 years in jail, different stories. That's one. Two, the Uber strategy only works if your customers will fight for you. And that is not a guaranteed thing, right? I oftentimes have to have these very awkward conversations with founders that will say to me, oh, just do what you did for Uber, we'll be fine. And I have to find a way to politely say, your customers just don't care about you enough, man. Like, it has worked for us. So Uber worked, obviously. FanDuel was another really good one. Bird worked. Ease worked. There are issues that work. But a lot of times you could have a company that is, some sort of SaaS business, like great company, but just nobody is passionate enough about it that they're going to take any time out of their day at all to advocate for it politically. Or you got something like Airbnb where people were afraid to advocate for it because if you were a host in a market where there was a question, it wasn't clear that what you were doing was legal or not in the first place, and you didn't want to risk getting in trouble, right? And so it's got to be the right issue. And then the next question is the level of government. So a couple months ago, maybe 2 months ago now, the U.S. Congress passed legislation banning TikTok effectively. They're forcing a sale to a non-Chinese owner in the next 360 days. TikTok tried the Uber strategy with Congress, and they flooded Congress with calls and emails and texts from users, and it backfired completely. And part of the reason why is you have to know who you're appealing to. When I worked in Congress, it's so high profile that even if you have a piece of legislation that's going to rename a post office to, Prashant's post office, 100,000 people will weigh in and complain about it or have some opinion about it, right? A city council bill could literally be 12 people. So when no one's ever weighing in on something, all of a sudden, if 3,000 people from your district all of a sudden tell you like, hey, leave this thing alone, that's really meaningful. If you're getting high volume all the time, then it's not going to really change. And also, it's who's making the call. So in the case of Uber, we were able to make sure that they were local people who were adults, who were either voters or likely could be voters, right? With TikTok, you're getting a bunch of 15-year-olds who obviously don't vote and can't vote. And it's like, who really cares what they think, right? Another reason why Airbnb couldn't ever do this, they kept trying and failing, is by definition, all of the scale in Airbnb is on the guest side, right? The idea is you have a certain number of hosts and they are renting out their home continually to different guests every night from all over the world. The problem is if I'm visiting Brooklyn from Delhi, I might have a great experience in Airbnb, and I might be willing to send an email to the local state senator in Brooklyn saying, hey, leave Airbnb alone. You know what the state senator says? I don't run for election in Delhi. I don't care what this person says. So unless you're a registered and likely voter in that jurisdiction, you don't matter. So this is a long way of saying when you're trying to decide whether to ask for forgiveness or ask for permission or beg for forgiveness, you got to take into account what are your customers like? Are they passionate about your product? Can you rally them in force? Who are you trying to influence? What penalties do you face if you don't get permission? And a few others. And if you weigh all of those, there's still never like a magic answer one way or the other, but you can make a smart decision.
Absolutely. That's an incredible amount of insight packed into one answer. And it's interesting to learn how much of business in regulated industries is connected to politics and political interest, right? Very interesting to learn. And at Tusk Venture Partners, you are focused on backing startups operating in highly regulated industries. That's a very unique business model to have. You're underwriting so much risk in that, right? So what all industries do you look at Tusk Venture Partners, and what are the risks involved with each of those?
Yeah, so I would say, first of all, we're somewhat sector agnostic, right? Like, because the reality is if it's regulated, we can deal with it. And the vast majority of companies are either directly or indirectly regulated in some way. There are a few areas that we really like and a few areas that we stay away from. We really like digital health. We've done a tremendous amount in that sector for a few reasons. One is the TAM is so big, right? Even each individual, like we're in a company that does, a different way to sell medical equipment, and they were moving it from the catheter equipment space into the dialysis space. And I said to the guy in our team, well, how big's the market for this? And he's like, 15 billion. Like everything is just giant, right? So that's cool. It's highly fragmented. It is highly regulated, and at least in the U.S., it's usually screwed up. So there's a lot of room for your portfolio company to do it better. We do a lot in fintech, transportation, gaming. Lately, we've been doing more in ed tech. There are a few areas also that we tend to stay away from. So one is it's not about the sector. It's about the point I made earlier, which is where in government do you need to solve the problem? We really like to focus at the state and local level. If the only way for a portfolio company to succeed is to pass an act of Congress in Washington, I'm not interested. Because literally when the phrase an act of Congress is synonymous with a miracle, I can't base an investment strategy or regulatory strategy around a miracle, right? And so if it's heavily DC focused, we're less likely to invest. We don't do biotech, not because the FDA process isn't regulated, but it's very prescribed and straightforward. And so can we do it? Sure. But a really good biotech fund that's been around for a long time, they could basically do it just as well as we can. So I don't have any material advantage where there's real arbitrage for me. If all of a sudden some company is told you're banned in 18 states overnight, and you have just chaos, like then my team is probably the only team inventor that could do this, whereas a lot of people could do things like biotech. And then there are certain areas where I feel like we just don't have material advantage. So like we haven't done any defense tech yet, not out of any ideological objection to it, but procurement of the U.S. Department of Defense is a very, very specific process. Neither I nor anyone on my team has ever worked in it. And while I could hire someone for it, so far the opportunity hasn't seemed big enough for me to do that. And so, really it's things that touch consumers, things that are regulated by state and local government, and especially issues like healthcare and fintech.
Yeah, that's very interesting. And there is this term that's used that's called regulatory arbitrage, right?
Yeah.
And it's there in some sectors, and in some sectors it's not there at all, right?
Yeah.
So which sectors do you think have more regulatory arbitrage, which have room for disruption, and which sectors are very strict in how they operate?
Well, let me answer your second question in two different ways, right? So there's sectors that are very strict in how they operate. So like, let's say that the SEC. So we've done a little bit of crypto. We invested in Coinbase. That went great. We invested in Circle. That's going to go really well too, I think. But we haven't done a ton because it really is by and large SEC dependent. There are some state components, money transmission licenses, bit licenses, and we'll deal with that stuff. But most of the action happens at the federal level. And the penalties for doing it the wrong way are severe, right? We're not just talking about having a scooter taken away or something like that, right? So that's one. The other would just be an area where there really just is no regulation, right? So if you're a cybersecurity SaaS platform and you're solely selling into businesses, odds are, there's really just not that much that's going to cover you from a regulatory standpoint. And therefore, there's no arbitrage for me simply because, what I do, it doesn't come into play. I mean, when we talk to founders who are in a regulated industry and know that and are worried about that, we very rarely ever lose a deal because my money is greener, right? If you and I are both offering the same amount of money to a founder, but I'm saying, look, you're going to have this problem. If you succeed, you're going to have this political problem, this one, and this one, right? And you have two ways to solve it. One is you could hire a bunch of lobbyists and PR firms and everything else, spend 7 figures, try to do it yourself. Or I can give you $5 million and I'll do it for free. Pretty good argument. We don't lose a lot of deals. But if you're a founder in a space that's not regulated, that means nothing to you at all, right? So the arbitrage only comes into play when the founder sort of, has to deal with that in the first place. So that's really where it comes into play is, are they going to run into regulatory issues? And tell me when this is getting too granular and boring, but we also break that further down into two different buckets. So the first would be the Uber, Airbnb, FanDuel kind of situation where a new startup has taken an existing business model and is tweaking it and disrupting it, but the entrenched interests already exist, right? And then we have a big fight that's really a fight over market share, but it's under the guise of regulation. The other half of it, though, is, like I said, crypto, drones, artificial intelligence, autonomous vehicles, whatever it is, where there's good and bad news. The good news is there's no entrenched interest. It's not like someone is out there trying to kill us. Bad news is there are no rules at all. And while it might sound good to have no rules, you really can't build multi-billion-dollar companies and industries in the absence of all regulation and rules entirely, right? There's got to be some structure. And so then it's about creating those. Sometimes that works really well, sometimes it doesn't. So, for example, if you just take drones and autonomous vehicles, they're both regulated by the United States Department of Transportation. Drones, the FAA governs that. The FAA has done a pretty good job, working on this, issuing regulations, issuing certifications. Like, they've done okay. DOT has been sitting on autonomous trucking regulations for 7 years now, and everything is stuck. So we're investors in an autonomous trucking company called Kodiak. We've been able to get them permission to operate on a state-by-state basis. They even managed to sell a huge contract, ironically, into the U.S. government. But when it comes from trucks crossing state lines, you need some sort of federal regulatory framework to do that. And the U.S. DOT has been totally asleep at the switch, and they have stymied the entire industry. So it also then just depends on who's regulating you. Are they proactive? Are they smart? Are they pro-technology? And can you get something done?
Absolutely. Thanks for the insights there. And so as an early stage startup or an early stage founder, how do you ascertain the regulatory risk in the space that you're operating in?
Yeah, I mean, it's a big part of our diligence process, right? So definitionally, there are two GPs that are fund, me and my partner, Jordan Knopf. And Jordan has a traditional investor background. I obviously, as we discussed, have a political background. So even on the very first call, the very first call is with the investment team, the associates, to see if there's any interest at all. So let's say they think it's interesting enough to filter up to one of us. The minute I'm on the call, I can't help but analyze it from a regulatory perspective as well as a financial perspective, because that's literally how my brain works, right? So I know kind of straight off, like, yeah, there's a lot we could do. Or there are times where we'll meet a company, and I'll say to, after the call to one of our associates, like, look, founder seems great. The company seems great. I don't think they need us. And the reality is, if they don't need us, we're probably not going to win the deal. Maybe we could, but like, all of a sudden, we're not really distinctive and special in that case. But then even if we get to the place of like, okay, they need us, then as we go through a very, very sort of arduous diligence process, a big section of it is we have in every investment committee memo something called, is there a Tusk edge? And that specifically says, what's the regulatory issue? What's the risk? What's the opportunity? How confident are we that we can solve this problem? If we solve this problem, how much growth does that unlock in the company? And if we feel really good about that, and keep in mind it's me, but also our whole platform team, and collectively we have, decades and decades and decades of experience in government and politics. And we like everything else about the business, right? We have to love the founder. We have to think the TAM is significant. We have to think there's real product market fit. But if we see all of that and we believe that we can really move the needle from a regulatory perspective, that's when it really makes sense for us to invest.
Absolutely. And are there any cases where initially the founders are often blindsided to the regulatory risk that's involved, and over time it gets exposed? Yeah.
Yes. Now, I would say a few things. One is the world has changed, right? So back when I first started doing all of this stuff, there was a lot of arrogance among founders around regulatory risk, where they would say, no, you don't understand. I went to Stanford. I was in Y Combinator. John Doerr is on my board. And when those stupid regulators see how smart I am, they're going to do whatever I want. And I'm like, dude, politics does not work like that. And they don't care who you are. Trust me. And that level of arrogance was very pervasive early on. I think it has mitigated a lot, because I think founders have seen what regulatory risk can do to a startup if you don't take it seriously and approach it the right way. And so, but with that said, I'm talking to a couple of founders a day. Right? I mean, the best part of my job is every day I meet with a couple of founders who have an idea. 99% of the time, statistically speaking, I'm not going to invest, but they're almost always interesting and smart, right? It's pretty rare that you're going to make it to me without there being something there that's worthwhile. And so like, that makes my job really interesting. Once in a blue moon, I still get a founder like that, though, who's like really dismissive, and they're out immediately. It's like, I'm not going to work with this person. Because keep in mind, we're investing at seed or A, which means I'm sort of married to you for like the next 7, 8, 9, 10 years, right? Especially if I join the board, you're part of my life. I'm part of your life for a long time to come. And if I dread every interaction, I'm going to be miserable, right? And so I don't invest in founders they don't be my best friend, but I have to say I can work well with these people. I respect them. They're pleasant enough. And so if someone comes in with that highly dismissive attitude, usually we knock them out immediately. But then at that point, the other question comes into play that you asked, which is let's say it's a self-aware founder, but where in the process? So Lemonade, like I mentioned, very beginning, you just can't launch the product itself without getting the regulatory approvals first. On the flip side, we led the series. We have a company called Sunday. It's an organic fertilizer company based in Boulder, Colorado. And I had all these ideas from day one around here's how we could pass local laws requiring either limitations on fertilizer with a lot of pesticides in it or mandating the use of organic fertilizer. Here's how we could use the regulatory process to build a regulatory moat for Sunday. And the truth is, we're only first now that we're sort of in the Series C really doing some of that work because they were just growing so fast that they didn't need it. And there was no reason for me to distract the company or any resources from that. Now that they're maturing more and more, some of the ideas that we had make a lot of sense. We're starting to put them into place. So sometimes our work happens right away. Sometimes it happens a little later in life cycle. We also handle all of the PR and communications for our portfolio companies. So like for Sunday, for example, in the years before we were dealing with legislative issues, we were still handling all of their communications, all of their PR. So we're really engaged with our portfolio companies. That's one reason why we have very concentrated portfolios, because we are putting in probably so much more work, quite frankly, into our portfolio companies than a typical fund does. Because it's not just like, oh, I'm a great board member and I'll help you find engineers and I'll, help you raise the next round. Like that's what every VC says, right? That's kind of not useless, but it's not that useful either. We are the PR GR department for your company, right? Which means we're really working every day. And we just can't, my fund's not that big. I can't do that for dozens and dozens and dozens of companies at the same time. So fund one, we had 18 companies, fund two, 19, fund three, we're at 18 right now. And I've got capital for about 4 to 5 new deals. So typically in that, 20-ish ballpark is where we need to be.
Absolutely. And when you're confronted with a regulatory risk, what are the different ways of managing that risk? Is it always the Uber way, or there are other ways to it as well?
No, I mean, by the way, even the Uber way wasn't always the Uber way, right? So there were lots of times where we quietly were able to resolve things, especially once we started winning, where elected officials were like, oh, my colleague in Kentucky just got his ass kicked by the voters. I don't need that problem. So, it's always cheaper and easier to get something done with a phone call than with a campaign. So first of all, that's always the goal. But yeah, it depends. There are times where, let me just use Lemonade again as an example. We had to legalize their product in state after state after state. And the approach we took was totally different depending on the state, right? In New York, it was an Uber-like approach because we were getting totally stymied by the bureaucrats in the kind of middle management. And I had to go way over their head to the governor, to the legislature, and force change top down. In Florida, they actually weren't opposed. They were perfectly fine to deal with, but the Florida law literally prohibited our model. And we had to pass a law that's now known as the Lemonade Law that enabled it to happen, right? In Texas, there's such like a, friendly for business jurisdiction. I called my friend who was the governor's chief of staff and said, hey, here's who we are. And he's like, great, what time do you want to pick up your license, right? And so that was really easy, So it doesn't just vary even company to company. It even varies sort of jurisdiction to jurisdiction. And, part of our job is to figure out what's the right playbook for this portfolio company at this time in this place. And that can vary wildly over the course of a life cycle of the company.
Yep. Super interesting. And are you sponsoring the entirety of PRGR for your portfolio companies? And how much does it cost really?
So yes, we are. I would say that by the series B, C, ideally B, if you haven't grown enough that you can afford to do that yourself, there's probably a problem, right? You're probably not going to succeed. And by the way, lots of companies don't graduate, right? Because that's the nature of early stage investing. So our goal is to come in, do all of the work, get you to a good place, help you build a team. And then, so take Roman, for example, which now goes by Ro. In the early days, we were the ones figuring out, can prescription via text be legal or not? Now Ro's got a GR team, they've got a PR team, but we're still talk to them all the time. I still talk to the founder a lot. Quince Jean from our platform team talks to them a lot. We've got a call with them tomorrow, actually, about a piece of legislation in New York that we're worried about. Whenever they need us, we're here. Whenever there's a crisis, we're here. But they get to a point where on a day-to-day basis, because ultimately you can't become in a regulated industry a highly successful company and not have the internal capabilities on how to do it. But in the early days, I would rather you spend your money on engineering. I would rather you spend your money on reaching consumers and customers. And if I can save you the cost on the GRPR side, I'd like to do so.
Absolutely. And also would love an insight into the cost involved of managing these regulatory issues. What's the cost? I mean,
look,
yeah.
So for me, it's my team, right? So we have 5 people on the platform team at Tusk Venture Partners, and they're each paid well. And so, it sucks up a chunk of our management fees. But even in those cases, there still might be times where we need to hire a specific lobbyist in a particular jurisdiction, because while we may know what the strategy is and we can manage it, you need the person that walks the hallways of the Tennessee legislature that has the very specific relationships. And usually lobbyists are $10,000 to $15,000 a month. And so even if all of our work is free, which it is, there's still likely to be other costs. And then, campaigns have costs. So if you're going to do a big grassroots campaign to rally your customers, there are technical costs to that. If you're going to do polling to show politicians, hey, this thing is really popular, don't mess with it, it can cost $50,000 to do a poll. If I'm going to take out ads, I've got to pay Google or Meta or whoever it is for the ads. So look, there are campaigns that might be in the tens of thousands. There are campaigns we've run. Look, that Uber New York campaign I mentioned, I think I spent $5 million in a month on that one. Now, look, Travis said to me, do whatever you have to do. I just can't lose this thing. I don't care what it costs. And I think to a certain extent, he was deliberately sending a message to mayors all over the world because the nice thing about New York is everything happens in New York is seen everywhere, right? So if there's a giant fight in New York, Mayor of Delhi is probably somewhat aware of it, right? Whereas if that fight were in, Charlotte, North Carolina, they have no idea, right? So we were using New York both to win that particular campaign, but also to basically set a precedent, in this case, globally. So $5 million was actually a very good investment. But yeah, it can be many millions. It could be tens of thousands. And by the way, there are times where it really is just my team figuring out a strategy, or we have a relationship and we make a phone call to the right person, and it doesn't cost anything at all. My goal is for it to cost as little as possible, because that's my portfolio company's money, and I want it used to generating revenue.
Absolutely. And you sound like a very optimistic person, and rightfully so. You're good at what you do. But is it in all cases that regulatory risks are managed successfully,
No.
or in some cases they're not, and company
They're not. I mean, by the way, there's a lot of deals we don't do because we don't think the regulatory risk is manageable, right? There are times where we love the founder, we love the TAM, we love the idea. We're like, you know what? We don't think we can win this thing. And my view is, if we're I'm being arrogant, but we're the best by a lot, right, in what we do. So if I don't think we can win, then we shouldn't do it, right? And by the way, sometimes I'm wrong, and it turns out we could have won. And sometimes I take things on and we lose. So these things are not, black and white. But sure, if you're an investor, and I often invite other VCs to just reach out to me and say, listen, if you guys are looking at a deal and you're trying to assess the regulatory risk, I'm happy to take a look at it. We may or may not have any interest in the deal itself, but I can at least give you an informed opinion, like, yes, this is a surmountable problem. You should not invest because of this, or you may not realize it, but this thing exists. This incredibly powerful union or special interest, exists that's going to hate this, and you're not going to have the money to beat them, and therefore the investment doesn't make sense. So I'm always happy to do that for other VCs.
Absolutely. That's amazing. And let's talk about how do you approach portfolio construction at Tusk
Mhm.
Venture Partners? Because a
Yeah,
big job of a VC is to manage risk within a portfolio. And
correct.
what you're doing is inherently decently risky, right? So tell us how
Yes.
you manage risk within the portfolio. Yeah.
Yeah, I mean, look, like I said, we have pretty concentrated portfolios. We are doing seed and Series A. We may, on a very rare occasion, do a B, but that's few far between. And we assume that roughly a third of the companies will probably go broke. A third will probably yield no more than a 1 to 3x. A third will yield, at least a 5 to 10x, and then we're looking to have a couple in every fund that return the entire fund. And we've been lucky that we've been able to do that so far. But look, we don't make a deal if we don't think it's capable of returning the entire fund. We don't make any deals thinking, oh, this will be a nice 1.5x. We're not private equity, right? We're early stage venture. So we always think this, but at the same time, you get it wrong a lot. One of the real challenges we face is when it's clear a company is not going to succeed, how do you continue to provide them with the support that you promised them without taxing too many of your own internal resources and not spending them on the portfolio companies that you know are going to generate returns for your LPs? And that's a tricky process, right? And we try to be as helpful as we can. But, obviously, like recently I had a portfolio company that is one of our best performing by far, and they potentially had an issue with the federal government, and it would have required a call to a cabinet member who I happen to have a relationship with. And I said, you know what? I've never asked this cabinet member for anything before, but this particular portfolio company to me is so, so important. It's a multiple fund returner. That if I need to make the call, I'm going to make the call. I wouldn't do that for everybody, right? So I have to make some choices and prioritization, within our own portfolio.
Absolutely, totally. And one interesting aspect of investing into regulated spaces is that it's a high risk and high reward game. I think more so than even generally VC is a high risk, high reward game, but I think it's more so in the regulated space because if it doesn't work out, then it can potentially go to zero. And if it does, then it can be a very strong moat as well. That you have won in a highly regulated market, and
Mm-hmm.
it's hard for a new competitor to come in and take your share, right?
Yeah, exactly. Yeah, I mean, and that's part of what we have to assess is a few things. Sometimes, like we were in investment committee yesterday, and there was a company we were debating in the AI space, and I felt like we could pass laws that would be beneficial to the company. Jordan made a really good point to say, like, okay, if you guys tell me you can pass the laws, I'm not going to debate. I believe you can. But how do you know you're not just opening up the entire market for everyone? And you know what? I think he was right. Once we went back and thought about it some more, I was like, yes, we can create a favorable regulatory structure, but there is nothing unique enough about this particular potential portfolio company that would let us create a moat specifically for them. And so do we really want to spend all this time and money just to open up the market for everybody, right? So sometimes the answer is you can't, you don't do the deal. Sometimes the answer is you can't, but you do the deal anyway because you feel like your company is still so much better. You have so much more belief in them. You're like, as long as it's legal, we can win, right? And so sometimes you make that bet. So it varies. Look, I remember like with Uber and Lyft, I always tried to find ways to distinguish the two, and I never could because the reality is it was the same model, right? There was nothing really different. So like when it came to FanDuel, we actually, even though DraftKings was our biggest rival, we teamed up with them on all of the regulatory stuff because our view is this is existential. Either we win these fights, we can exist, and now we can compete against each other, or we lose and we're both out of business. And we teamed up. There are other times where we don't want to work with other players in the sector because we believe that we can distinguish ourselves in a way that really advantages our portfolio companies.
Right, that's great. And let's move to the last main question before we move to the rapid fire round. And
Sure.
this is that what's your perspective on the current venture market and the returns it is able to generate compared to other asset classes?
Yeah, I mean, look, I think that obviously it's not a secret that there's been a total lack of liquidity in venture for the last 3 to 4 years. And I think we got to a point, and this is unfortunately the cycles that markets tend to have, where things got out of control, valuations got way too high, too much money was raised, too many venture funds were raised, and the bubble had to pop, and it did. And I think part of the problem is people were raising funds that are just too big. Our funds are sub 200 million, and that's deliberate because my view is to make good seed and Series A investments, I just don't need more money than that. And my ability to generate meaningful returns for my LPs and meaningful carry for myself is a lot greater with a smaller fund size. Now, I'm making less money in management fees, so therefore I'm taking home less guaranteed cash every year. I'm taking on a lot more risk as a result, but I think that's the right thing to do and the smart thing to do. But you got to a place where, because institutional LPs were willing to throw so much money at venture funds, people were raising, $600 million Series A funds or $10 billion multi-stage funds or whatever it was. And then the problem is, if you have a $600 million Series A fund, you can't write a $4 million check into a deal, because what are you going to do? 100 portfolio companies, right? So, you say, well, I really can't write a check smaller than 12 million or 15 million. So instead of the valuation being, 4 on, so let's say that the round is 8 on 50 and we're half of that, it's going to be 20 on 130, right? To make your own math work. But then what happens? Everybody's in on the game. So at every successive stage, the valuation gets bid up and up and up. And then it goes to the public markets and they get slashed by 70, 80% in the first few months. And the public markets are right. These companies are just wildly overvalued. WeWork. Is there a value of WeWork? Sure. It's a real company. We've all been in WeWorks. Like, it's a cool space. Like, that's not nothing. At the same time, was it ever a $47 billion company like SoftBank said? Like, no, it's a $2 billion company, right? So it's not that there isn't a proper market value for just about every successful company, but it was what VCs were valuing it at were so wildly out of whack with reality that I think it led to this giant collapse. I think the only good thing that will come out of this collapse is, putting AI aside, valuations have come down meaningfully. They are a lot more reasonable. Typically for us at Series A's, it's usually in that kind of 40 to 60 range, post typically. Something could be a little more, but usually in that area. And there are a lot of venture funds that got created that don't really have any great reason to exist, right? So, my fund, you can like us, you cannot like us, but we have a very clear differentiation, right? We are the only fund that solves the regulatory risk of our portfolio companies. We have a clear reason to be here in the market. But if you're just like, oh, I was a partner at Sequoia or Andreessen or Khosla, whatever it is, and then I started my own fund, like, great, but like, what do you bring into the marketplace that's so special that people need to have you? And if the answer is nothing, then the only way you win deals is by just bidding up the price, right? So I think as those funds get washed away because they won't be able to generate any DPI and therefore they can't really raise a next fund, I think things will calm down. Now, with all that said, AI pricing is much higher, right? So I am right now looking at a Series A that has a valuation of 160 million post that I think we might do. And it is high, but I think that in this case, this company's particular focus and technology and expertise and our ability to deal with some of the regulatory questions is meaningful enough that this valuation may make sense, right? But I'll give you like Bird. When we invested in Bird, we put in $1 million at a $50 million valuation for the Series A. That made sense. 18 months later, it was at like $3 billion. That made no sense, right? Like, I was happy to have my investment marked all the way up, but I didn't understand it at all. I was like, man, maybe I'm just like too dumb for this venture capital stuff, because I really just don't get how this is a $3 billion company. Of course, it wasn't. It has literally been delisted. It barely even exists anymore. And we luckily sold off our cost basis to a Japanese hedge fund at a $2.2 billion valuation. So we were one of the only funds to actually make more than a 1x on the deal. But clearly, things could often get out of control. And so to a certain extent, just like I said before, don't do a deal with a founder that you don't like, because life is too short and they're just, you work with them too much. If something doesn't make sense to you, it's probably because it doesn't make sense, not because you're too stupid to understand.
Absolutely. And there's a very important lesson in there that VCs should not always throw parties at their markups. Instead, they should think sensibly. Does that actually make sense or not? And if it doesn't, probably look for a sell-off or secondary.
Yeah. We are active on the secondary market. And you know what? I know that VCs are always very afraid of upsetting their founders. But what we have found is when we say to our founders, listen, you're running a business, so are we. And it's not like we're dumping our whole position. We're taking, 20% off the table or whatever it is. We have found them to be very receptive to that, especially, by the way, if the founder and the management team are selling off some stuff in secondary too. It's like, well, if you're doing it for good reasons, so are we. So I don't think VC should be quite as afraid as they seem to be about this.
Absolutely. Great insight there. Awesome. Let's now do the rapid fire round. I'll ask
Sure.
you 5 quick questions about the investing you're doing, and you have to give 5 quick answers.
You got it.
First one, what are the sectors and regions you invest in?
U.S., sometimes Israel, healthcare, fintech, transportation, gaming, education.
Awesome. What's the typical stage of investment?
Seed and Series A.
Typical check size?
On seed, 1 to 2 to 3 million, but we do a lot more Series A, 5 to 7 million.
Do you lead deals or do you follow along?
Both. We will lead, we will co-lead, we will co-invest. We're pretty flexible about that. We also are not as ownership sensitive as maybe other funds, so we don't need to get 20% plus in a deal for it to work for us.
Right. Where can founders get in touch with you if there's a direct way?
Yep, Bradley at tusk.vc. So you just email me, and if it looks interesting, I will get someone on the team to start looking at it. And if they like it, then you and I, who are the founders, will end up meeting. And if it all works out, we'll be working together for a long time.
Awesome. Last one, where can our listeners follow you?
LinkedIn. So I have come to the belief personally that social media is like the unhappiness machine. This is a much longer than a rapid fire answer, but to me, anything that its 2 key characteristics are to show you what you lack in comparison to everyone else that you know, because you're comparing your real life to their fictional life. And then you're seeing everything bad happening everywhere in the world all at once. Like, it just makes people miserable. And I realized, like, I don't need this. So I am not on any platform anymore, but I am on LinkedIn. So you can follow me on that. Also, I have a Substack and a podcast. So if you like the kind of content that we just talked about, you can follow along on it. If you go to bradleytusk.com, you can get links to everything.
Awesome. I'll make sure to put all the links in the show notes below.
Great.
This for making time for this, Bradley. It's been a
this was great, man. This was really fun, Prashant. Thanks so much for having me.
Thank you. Pleasure.
Take care.